Okay, let's look at this situation and let's calculate the after-tax cash flow, assuming this is set up as an LLC and then assuming it's set up as a C Corp. I'll read the problem to you. Andrea would like to organize show is either an LLC taxed as a sole proprietorship or a C corporation. In either form, the entity is expected to generate a 15% annual before after tax return on a $470,000 investment. Okay, see where I'm reading? Andrea's marginal income tax rate is 35% and her tax rate on dividends and capital gains is 15%. Okay, Andrea will also pay a 3.8% net investment income tax on dividends and capital gains she recognizes. If Andrea organizes show as an LLC, she'll be required to pay an additional 2.9% for self-employment tax and additional 0.9% for the additional Medicare tax. Further, she is eligible to claim the deduction for qualified business income. Assume that show will pay out all of its after-tax earnings every year as a dividend if it is formed as a C corporation. All right, so let's take a look at the LLC first. And here's the logic. First, you figure out what the pre-tax earnings are. They gave that to us at $470,000, right? $470,000. And then we've got to include the 15% annual before tax return. Okay, once we calculate that, we then list the entity level tax rate, which is given, and the entity level tax. Okay, now once we have that, we can come up with the earnings after entity level tax. Okay, now keep in mind that the entity level tax rate, therefore the entity level tax as well, only applies to the C Corp. Next, we have to deduct the 50% of the self-employment tax under the LLC, right? And then you need to factor in the QBI deduction. And once we have that, we can calculate the net income taxable to the owner by adding up the earnings after entity level tax, the deduction for the 50% of the self-employment tax, and the QBI deduction. Okay? Then the income tax paid by the owner gets multiplied at 35%, and we have to consider the self-employment tax, and they gave us the percentages to use there, the 2.9%, right? Okay, and then we need to consider the additional Medicare tax, net investment income tax that relates to an LLC. Keep in mind that amount is different under an LLC than under the C Corp because of the self-employment tax that applies to an LLC but not to a C Corp. Okay, at that point we can add up the appropriate lines, which would be income tax paid by the owner, the self-employment tax, and the additional medical tax to come up with the owner level tax. Okay, so to calculate the after-tax cash flow, you take the pre-tax earnings, which is line 1, and subtract the owner level tax, line 11. Okay, that's how we would do LLC. Now, under a C Corp, we start off by taking 15% of $470,000 as our pre-tax earnings. We then need to multiply the pre-tax earnings by the entity level tax rate to come up with the entity level tax. And the entity level tax rate is 21% for this particular problem. Okay, next we would deduct the 50% for self-employment tax and the QBI deductions, but of course that doesn't relate to a C Corp. But we do need to then determine what the net income taxable to owner is. So line 7 under corporation is equal to line 4. Okay, and following the logic down, we have no self-employment tax, but we need to calculate the additional Medicare tax, net investment income tax. And in this case, it's only what we get for line 8, or maybe another way of saying that is the net income taxable to the owner times the 0.038 net investment income, right? There's no additional Medicare tax under this situation. All right, so now the owner level tax under a corporation would be the total of what you get for line 8 plus 10, and then the after-tax cash flow is calculated exactly the same as the LLC by taking line 7, which is net income taxable to the owners, minus line 11. Well, actually, it's not exactly the same. Under an LLC, we take the pre-tax earnings minus what we calculated as the owner level tax. And under the corporation, we take what we calculate as net income taxable to the owner, which was line 7, minus the owner level tax, okay? And that's the logic you need to follow to tackle this one.